For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, that it is, Managing Your Financial Future. Welcome back. Another podcast for you. Happy to be here. Happy to have Professor Rick Plum, Certified Financial Planner Professional and Accredited Wealth Management Advisor here with me. I am Johnny Dean, your podcast host. You should know that by now. 240 episodes into this thing. Rick Plum, there's no prize for this. But
well, darn, of course not. Not if I'm involved.
No. Maybe at 250. I don't know. 250 seems like a nice round number that we're going to get to here. But that's like not for another 10, 12 weeks. So that just seems like a long way away. So today's topic, now, if you look at it just as a title, which has to do with things like value averaging and dollar cost averaging and all that stuff, sounds really nerdy once again. You know, one of those things that just sounds like, oh, really?
Oh, I am what I am. What can I say?
So, well, but there's a reason that we're going to be talking about this kind of stuff, and I want to dive right into this because we've had questions on this. Now, many of us know about this idea of what we call dollar cost averaging. Now, that's what often helps to build savings during the accumulation phase of our financial life. Now, the 401k, of course, Rick, is a great example of dollar cost averaging. You put a set amount in, over a regular period of time, and you purchase assets at whatever price they happen to be at that time. So let's say it's stocks, right? When the market's up, your set amount of dollars purchases fewer shares because each share is more expensive. When the market's down, the opposite is true. You get more shares for the same number of dollars. And over time, the idea is that it can lower your average cost per share and help reduce, I think, the emotional temptation to kind of time the market because you're buying consistently through both the highs and the lows. Would you agree with that assessment on dollar cost averaging?
Well, I would say that most people, even if they've never heard of dollar cost averaging, is using dollar cost averaging because they have a 401k, they have a savings plan. Especially anybody listening to this podcast most likely has some form of investing and savings plan. And they used, whether they knew it or not, dollar cost averaging to get where they are today. They use the systematic approach because that's basic. Unless you inherited it, that's about the only way most people can save money is systematically through payroll deduction and things of that nature. And by its very nature, it does help. And it does exactly what the name says. It averages your purchase price, and it averages it generally to a lower number. Because the one thing we can be sure about in the market, the one thing that we can say without a doubt is going to happen in the stock market is that it is going to go up and down. It's going to have volatility. That is the one thing that's the one constant, is that it's going to be volatile.
Is that the guarantee you can give?
I don't know if I'm even allowed to use that G word, but yes.
Okay. All right. Okay.
But so we know that it's there. We know it's going to be volatile. How do we take advantage of it? It's that old thing. Buy early, buy often, just keep buying. Buy when it's high, buy when it's low. But as you mentioned, if I'm using the set dollar amount, I'm using a specific percentage of my paycheck or a specific dollar amount for my paycheck every time I get paid. When the stock market is higher, I'm buying fewer shares. When the stock market goes down, we've said this before, that people that are in their 20s and 30s that are starting off their savings plans, what they want the market to do is very different than what us old guys, in our 60s and older, want the market to do. Us old guys, we want the market to go up and never go down. The people, because we have money in the market and we don't like to see our money go down in value. People that are starting off that don't have very much money in the market, that are consistently saving, they want the market to crash, at least in theory, and they want it to go down so they can keep buying and buying and buying on sale when the market's down. Actually accumulate some shares when they're cheap, so that when the market does come back, they actually have something that comes back. And so that's what dollar cost averaging helps us do. When the markets are down, we buy more shares. When the markets are higher, we don't buy as many shares. And so our average purchase price is a lower dollar amount, which is a good thing.
And that works because of the amount of time that the young investor has.
Time is Yeah, it's our friend.
Yeah, they don't mind a crash because things are cheap and they can't touch that money anyway for 35, 40 years. So, what do they care? So that's why. Now, okay, so that's dollar cost averaging. And as I said, most people, at least many of us, know about it because we practice it so much in our 401ks, 403bs, workplace retirement plans. But there's another strategy that we're going to talk about today that I want to revisit because we have gotten questions about it, as I've said, over the last several months, in fact, several years. And that strategy is value averaging. Now, Rick, before we get into talking about this and how it relates to your savings and investing strategy, can you just give us a simple explanation of what this value averaging is and how it's somewhat different from this dollar cost averaging?
Well, before I get into that, I want to make a differentiation between what we talk about in value averaging and what you would find if you Googled value averaging and you found dollar value averaging. Mm-hmm. Dollar value averaging is an accumulation issue. Dollar value averaging is a change to the value averaging in that if the market goes down 10 or 15%, if you were doing $100 a paycheck or whatever, and the market goes down 10 or 15%, you do 110 or 115%. So you're making up the value. You're saving more. You're saving more when the markets are down, and you can actually back off on when the markets are up a little bit. So it's accentuating that value averaging concept. We talk about straight value averaging. It's not a systematic issue. It doesn't happen automatically. It's not based on a specific set rule, if this, then that. It's a matter of understanding where we expect to be. Once we've identified the investment that we are going to use, we're putting an expected return or a volatility on that particular investment. And when that return that we're receiving, if that return that we're receiving exceeds the expected return by a significant enough margin, we actually will sell some of that higher than expected rate of return. It's not for accumulating net worth. It's different than trying to build your portfolio. This is trying to, once you've started your retirement, basically, once you've started taking money out of your retirement plan and you've done it properly by bucketizing it properly, we know what we expect out of bucket number one. We know what we expect out of bucket two, bucket number three. If our expectation, bucket number three is our long-term growth portfolio or portfolios. It may be different things. If we expect, say, a 10% rate of return in bucket number three, and we had $100,000 there at the end of the year, we expect to have $110,000. Okay. If it's at 110, 111, 108, we're kind of right where we expect it to be. But what if it's 140 because it was a bizarro, incredible year?
That is a really good year, by the way.
Okay, 40%, maybe bigger than expected.
Right.
And it doesn't even have to be that much in 1 year, but what if you go back to like 2020, 21, 2019, 2021, where each of those years was a 20% plus year. So we were up more than 60% over 3 years instead of up 30% or 10% a year. We're way ahead of where we expected to be. Value averaging is taking a look at where we expected to be, comparing it to where we actually are. And if we're way ahead, we take some cream off the top. We take some of that excess, not all the return, but some of the excess return, maybe all of the excess return. What's excess return? If I thought I was going to get 10 and I got 15, there's 5% excess return. We take some or all that 5% and we put it into something very safe, like a bucket number one investment. This is not a matter of necessarily market timing. This is saying, you know what? We just did 20+% for 3 years. At some point, we're going to give some of it back. So let's take something off the table, get some dry powder for the future when it does potentially go down. I don't know that it's going to go down. I don't know when I do know that it's going to go down someday, but I don't know when. And I'd like to have some money on the sidelines so that I have less going down when it goes down. I'm where I'm supposed to be or better in my bucket number three. Let's take advantage of what the market's given us. And then if the market goes down, I've got some dry powder. I can buy in on sale when we're doing that. So we do value averaging in a couple of ways. One is when we're way ahead of the game, where we expect to be. But this requires you to know where you expect to be. It's a matter of, if you have no idea where you're going, you have no idea if you're on time.
That's a pretty good analogy right there. So you need to understand. You need to know.
You need to have a plan.
Yeah. Well, that's actually the overall theme of of this particular episode, is that it all boils down to that. So that is value averaging. Now it does take more mindfulness. Then
it takes a little bit of management is all.
Yeah.
And it doesn't take a lot. I mean, like I said, if you've got, your bucket number 3, you're retired, you're no longer adding to the portfolio, so you don't have to take that into consideration. You know what you've got in bucket number 3, you put an expected rate of return on it, and you monitor it, and if after a year you're up 25% instead of 10, consider, now this is not, again, it's not an automatic, consider taking some of that money off the table and safening it up or putting it into something that doesn't have the same volatility as what you're looking at right now. So we're looking at the other side is if the market's way down.
Yeah.
We expected a 10% rate of return and it's down 20% or more, like we saw in 2022 after those 3 years of better than expected returns. Maybe if you had been doing this, you took a little money off the table in 2020, took a little money off the table in 2021, and then in 2022 when it went down by 20%, you had some extra money to put into the market at the downside. I'm not saying you're going to pick the very bottom because nobody's that good, or there are some people that were that lucky, but nobody knew for sure that that's what the bottom was. You only know that when you look back at it. So it's a matter of putting yourself in a position to take advantage of the one thing we know the market's going to give us.
The thing you mentioned just a little bit ago?
Volatility.
Now that we've kind of defined what this is, I want to kind of run down some of these questions that we've got from people, and I'm not reading the whole thing. I mean, what I essentially did was take some observations and questions that we've gotten over the years and kind of feed them into an AI that gave me the gist of it, so that I can reduce it to a single question, and that makes things easier for listeners to understand. And it's kind of like averaging what these questions are here. So question number 1 that came up quite a bit: doesn't this strategy of value averaging reduce your overall rate of return over long periods of time? And I think what they're talking about is during the accumulation phase. That would be my guess.
Well, and even in the distribution phase, if the market does nothing but go up and you're selling when you're way ahead of the game, obviously you're not 100% invested in the things that are going up. So if the market does nothing but go up, yeah, you're going to lose out a little bit. Not a lot, but a little bit. You'll be in a much safer position. You'll be in a much more emotional, stable position. But if the market does nothing but go up, yeah, you're going to lose out on it. But how many times does the market only go up and never retrace its steps? Now, if we look over long periods of time, yeah, it goes up. If we look over 15, 20-year periods of time, it goes up. But if we're also doing both sides of the value averaging, not just selling when it's at the top, but buying when it's down, there are down times. I mean, the last 10 years have been pretty good years. I mean, not bad. I mean, 15 to 20 for 25. If I just stayed invested, and it makes, obviously, accumulation is a different game than distribution, I would have been fine. But if I had done some value averaging, sold in 2021 and bought in 2022, I would have been better. It can enhance, and it might clip off some of the tops a little bit, but it's more from an enhancement side. It's more from an emotional side. And the reality also is we're trying to create a stable income. And we know that we need 10 plus years for stocks to give us that better than expected or average or better rate of return. And so as we're spending bucket number 1 down, value averaging is also a way to continually potentially reset our 15-year time horizon.
And it can buy you a little bit more time.
It buys you more time.
Yeah.
For those unexpected, unpredictable, nobody can tell you when it's going to happen down days, down months, down years.
And what we've heard from retirees, and not just us, but this is very common, is that they would rather protect themselves on the downside potentially than go for the gold and try to get the biggest rate of return. Rate of return is great, of course, and you need that.
The old saying is, we're not trying to make you uber rich. We're trying to keep you from being poor.
Now, the couple more questions that we had on this, I'm not sure where this one is leading, but the question was, doesn't value averaging just lead you to buy more of your worst performing investments? In other words, are you doubling down on underperformers rather than letting the winners run?
No, not at all. Yeah. That's what rebalancing potentially does. This isn't rebalancing. This isn't taking a stock portfolio that has 20% small cap, 30% mid cap, and 50% large cap. And when the small cap goes down, the whole portfolio goes down, we reduce it and we build it back up. So I'm buying into what was at that time the worst performer, which could be then the best performer coming forward. So that's a different game. That's rebalancing. That's within the same potential, same typical asset management category. We're talking about long-term growth in all of those stocks. We're talking about rebalancing across asset classes, big-time asset classes, cash, bonds, stocks. When we pull money out of the stock market, we're pulling it out of the overperformers and putting it into safer investments that, by very definition, are completely different investments. They're not expected to perform as well, but they're also not expected to lose anything when the markets go down. We're trying to avoid losing money. We're not just reshuffling the deck.
Well, and I want you to address this one, too, because along those lines, the question has been, well, then isn't value averaging just basically market timing?
It's definitely not market timing, because we're not saying this is the time to sell. We're saying this is an opportunity to sell. We're not saying this is the top of the market. We're not saying that tomorrow this stock's going to go down, you better sell it today. We're saying, you know what? It's had a good run. It could go up tomorrow. It could go down tomorrow. But at some point, the odds of it going down become more than the odds of it going up. Not saying that that's going to happen tomorrow, but I'm happy with the return that I've got. I thought I was going to get a 10, and I got a 25. I'm ecstatic about the return I got. I'm happy with that. Let's take some of the money off the table.
Yeah, it's kind of like locking in these the gains that you have.
And if it goes up another 25% next year, I still have money in that investment to do that.
Yeah, and maybe you have a little less than if you left it in, but as we said, retirees or people who are in the distribution phase care quite a bit less about that. At least that's what we've been. That's what all the research shows. Okay, so here's an interesting question that we had, and this was fairly recent. Might have been the last time we talked about this, but the question was, how do you implement value averaging in a taxable account without triggering constant tax consequences? Because you are selling and buying,
potentially selling gainers.
Stuff. Yeah,
you are, and at some point, and so value averaging doesn't happen quite as often. So if I set my parameter, my thought process that I expect a 10% rate of return, but if I get if I'm supposed to, so after 3 years I'm supposed to get 30%. If I'm up more than 45, 50%, I'll value average. Maybe I extend my parameters a little bit for taxable accounts. But at some point, the risk of, when you've had 20, after a while, there is what they call a reversion to the mean. It's inevitable. It's going to retract a little bit. The risk of the retraction is more dangerous than the taxes that you might have to pay. And it also goes by age, too. Because if I'm looking at a 65-year-old, the likelihood is they're going to sell that stock at some time during their lifetime. If I'm looking at a 102-year-old, I'm not as likely to sell it because I can get a step up in basis in the not too distant future. I hate to say.
Well, we're being realistic here. I mean, 102. It's the clock is ticking fairly loudly at that age.
So, and those kinds of factors. But at some point, the risk is greater than the taxes. We've been through this with some of our money managers on short-term issues, where we had one manager who bought. It was they buy and sell. They're doing their job. They bought a stock at maybe between $14 and $25 a share as they went along, and in 11 months, less than a year, 11 months only, they sold it at 114. they got a 4 or 5 bagger out of it. And we're thinking, can you just reverse those trades and hold on to it for a month so that the client can get a long-term capital gain? It would cut their taxes, by quite a bit. And the manager said, the risk of holding it is too great. And you know what? This time they were right, because at the 12-month mark, that stock was only $58 a share. So sure, if we'd held on for through the 12-month period of time, we would have paid a lot less in taxes because we didn't have anywhere near the gain, and the tax rate would have been less. But I would still rather have paid the tax on the 114 at a little bit higher rate than a little bit lower rate at the 58.
That's a great answer to that question. And as I said, I hadn't considered that.
At some point, the risk outweighs the tax.
Yeah, and that's where you need, I think, help with an advisor on this. Let me see. Where were some of these? Some of these are, here's an obvious one. The question was, doesn't value averaging assume you know what your portfolio should be worth at each point in time? In other words, how do you accurately set a target path if markets are unpredictable?
Well, they're unpredictable day to day, week to week, year to year, but they're not that unpredictable over 10, 15, 20-year periods of time, where we can get more into what's expected over time. And so we're taking that short-term volatility using long-term expectations to determine whether or not we are ahead or behind grade path. And so each bucket's going to have a different, each investment for that matter is going to have a different barometer that you're judging it with. And so we are using that long-term expected returns to determine shorter-term, movements. I don't know what else to say on that.
Well, it just, as we said before, this strategy does require some oversight, or at least you got to kind of take a look at it. As you said, if you expected 10% and you got 11% or 12%,
not that big of a deal.
Yeah, you may want to let it go. And again, this is not to state your other point. This is not a regular thing. You are not doing this every single year. Or
this
twice
is not
a year.
Something that the computer is going to trigger and do automatically.
There was a phrase that I liked that came up in the advisor roundtable we had earlier this week, which was I think they called it strategic value averaging or something like that. It was a good phrase, and I think that's what we're talking about here. Let's see. Well, I don't know how you're going to answer this, but what happens if you don't have the cash available when your portfolio underperforms and the strategy tells you that you need to invest more? So I guess when the market's down.
So what happens if you set your allocation up, you have X amount of dollars in bucket number 3, and before you get a chance to take some cream off the top and create your dry powder, it drops.
The cream disappears.
There was no cream, and the milk disappeared, or at least half the gallon did. You set your plan up with anticipation that we're doing this in case it drops. Okay, so you don't get to value average right now because you don't have the extra cash. You could potentially take some money out of bucket number 3 or 2, and maybe even a little money out of bucket number 1. But the plan was set up with the expectation that you could withstand a 10 or 15, 20, 30% drop right away. Unfortunately, it happened. It doesn't happen all the time. Just because you are Murphy doesn't mean Murphy's Law is going to do it every single time. But sometimes it does happen. And, if you can't take advantage of it, you can't take advantage of it. Now, it also depends on how far it drops. If it drops 5, 10, 15%, whatever. If it drops 75%, I'm borrowing money.
That's not a recommendation, by the way. I'm going to
it's never dropped that far either.
No. I think we got bigger problems if it drops 75%.
Yeah, we do have big problems at that point.
Yeah, short.
But your bucket strategy does not.
Well, and that's the thing. See, and this is why this is not a regular thing. If you retire, if you retired in 2022 and you had a bucket strategy set up, and your bucket 3, by the end of the year was down 20%, or I don't know what it would have been, but something like that. I don't think you're even going to be that concerned about value averaging your strategy back up, because you say, look, I just retired. This bucket 3, I'm not really touching this money for 15 years.
I got 14 more years, and so it didn't go like I wanted the first year. That's why I did the buckets in in the first place.
Right, and I could say goodnight and not have to, have
No
to
stress
sweat
at
it.
night.
So, I think this, again, is why we talk about strategic value averaging. I mean, it doesn't have to happen. And the reason you set up this bucket strategy is not so that you can get some great rate of return and make sure that you get 10% or 20%, whatever it is, 10% every year. It's more that you have a cash flow. That's really what you're concerned about when you're in the distribution phase of your financial life.
And we want, in many cases, to be able to leave a legacy for the heirs. And just because the market dropped doesn't mean that I'm going to die that day. The fact that I bucketized and I'm not worried about my income means I'm less likely to jump off the cliff.
Yeah, and if the market drops and you're 10 years into retirement, I mean,
well, most likely you've done some value averaging, so you still have a 10, 12-year time horizon on your bucket one too.
Yeah,
you're not worried.
I guess my question for you in this case would be, if you're already bucketized and you've got the time horizon, what would be even the point of value averaging? I mean, I understand why you'd want to do it, but
if you're properly bucketized, you don't need to value average. This is just a way to give ourselves a better feeling of managing our world. We're always looking to reset that 10 to 15 year time horizon. If I've been spending my bucket number one down and I only have 1 or 2 years left in it, now I've got a shorter than 10-year time horizon. If I've got good returns in my bucket number three, bucket number two, I should be resetting my buckets to give myself the opportunity to have that longer term safety net, I should call it. But you don't have to. And it also depends on what you've got in bucket two.
Well, yeah. So as I'm listening to this, I'm hearing you talk about this. It sounds like the value averaging strategy on the upside for a retiree is, although it's optional, can be a better thing to do than to have to worry about it when the market's on the downside. Would you? Is that?
Well,
accurate?
I see more people value averaging when the markets are ahead of game, than buying in when the markets are below grade. That's just. You want me to buy in when the market's down? I'm fine. I got plenty of time for it to recover. I don't need anything else. But it's a harder thing to get people to do.
And that goes back to human nature and all that stuff. So the reason I'm talking about this is really more something to think about, even for somebody who is, as you said, properly bucketized. It's just something to think about when you've got extra gain.
When you're way ahead of where you thought you would be.
Yeah, what it's going to do is buy you what I think is the most valuable asset you can possibly have in your portfolio, and that's time. Time
is our greatest ally when we have it.
The older you get, the more valuable you find time to be, and so this is why things like this happen to resonate with me. If you'd like to know more about this stuff, strategies you can use, especially strategies during the distribution phase, which is a whole. I'll have to talk about this again, not today, of course, but at some point soon. The skill set and the strategies you use in the distribution phase of your life are far different from the skill set and the strategies that you're going to use during the accumulation phase. I know you would agree with that statement.
Well, I would say they're just more involved because in your long-term growth bucket, which may only be a third of your overall portfolio, you're doing a lot of the same things you did while you were accumulating, just not dollar cost averaging. You're doing your asset diversification and things like that. But then you're on top of that adding in a lot more management of cash flow of bucket number one, bucket number two that you didn't have for just your growth portfolio. You still have a growth portfolio. You're still managing it. But in addition to that, you're managing a couple more portfolios that you did not have when you were 25.
Correct. Talk to your Lucia Capital Group advisor. If you don't have one, talk to a Lucia Capital Group advisor, like Professor Plum or any of their the people who work with Rick. 800-644-1150 is the number at Lucia Capital Group. 800-644-1150. Maybe value averaging strategy could work for you. Maybe it's not something that you need to do, but it's something that you could consider anyway. Potential tool for you to use. Again, 800-644-1150. You can go online at luciacap.com, LuciaCap.com. luciap.com, and find articles on this. We do have a couple of videos, I do believe, but you can find all this stuff, strategies, things to talk about at luciacap.com. You can also download our guides that we have. I don't know if value averaging is mentioned in the bucket strategy guide. It may be. I'd have to look at it, but download it anyway. Go to the search bar, type in bucket strategy, and you can download that bucket strategy guide. We have an estate planning guide, a social security guide, all kinds of things that you can use, tools, instructional videos, whatever it is at your disposal there at luciacap.com. Don't forget to subscribe. Always subscribe. Well, do it once and you're done. Apple Podcasts, Spotify, managing your financial future. Make sure you listen to every single episode because, like me, hey, you know what? You learn. You learn a lot. All right, out of time for Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean, managing your financial future. Thanks so much for listening. We'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice. It is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A value averaging strategy does not guarantee profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Stock investing includes risks, including fluctuating prices and loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.